Is a recession coming, and can you talk yourself into a recession? The answer to those questions is yes and yes. Recessions happen every few years, and the most likely reason for the next recession is we're going to talk ourselves into a recession. But what does that mean for the housing market, and how will a recession impact housing prices? I don't want to hype up the idea of a recession. All I want to do is talk about it or discuss it with a clear level head. I'm seeing a growing increase in the number of comments on my videos stating that a recession or a crash is coming. One person in particular comments on nearly all of my videos. I hope he doesn't mind that he's been mentioned in this video, but Guy Local nearly comments on all of my videos. But if you want to comment on one of my videos and you want me to answer a question or address a particular subject within a new video, put your comments below and let me know if you have any questions that you want me to address directly within a video, or perhaps some issue you want me to discuss. But I am seeing more and more comments on my videos that a recession or a crash is about to happen. I'm also seeing far more YouTubers promoting the idea that a crash or recession is about to happen as well. If you are a subscriber of this channel and you want more general information on the property market, you might consider subscribing to our newsletter. You can do that after this video in the descriptions below. Please support the channel so we can reach a wider audience. Hit the like button, subscribe to the channel, comment and share as well. There's always going to be recessions and crashes. Predicting them to the month or the quarter is very difficult. Slightly bit easier predicting them to a year. But if you are predicting them to happen, they will happen. And if you're saying it for 3 or 4 years, you're definitely going to be right at some stage. In the US alone, there has been 33 recessions since 1854. And generally speaking, on average, recessions have lasted for about 11 months. Generally, recessions happen every 7 to 10 years, but the frequency is getting shorter and shorter as markets react quicker and quicker. The standard definition of a recession is 2 consecutive quarters with negative GDP. This means that there's been at least 6 months of negative growth within an economy. There are some economists that want to make that definition shorter in terms of a few months rather than 2 full quarters. There was a small recession in 2019 just before COVID hit. Also, there was a few months of negative growth in 2020 as well. There are loads of factors that can trigger a recession: a hike in interest rates, huge increases in commodity prices, inflation, bond rates, housing or stock market crashes, a drop in manufacturing, or a drop in consumer confidence. All of these factors are on the table at the moment. Central banks are suggesting that there will be interest rate hikes. However, those interest rate hikes are likely to be small and on their own won't trigger a recession. Short-term bond rates are getting closer to 10-year bond rates. This means that investors are more concerned about the short term. Commodity prices like oil have increased dramatically. We know a lot of this is down to Russia invading Ukraine at the moment and sanctions on Russia, but there are other factors at play as well. We should all be fully aware at this stage of high inflation rates across the globe. This is having a knock-on effect in terms of consumer spending power. It increases the cost of manufacturing, transport, construction, and all of this is leading to wage demands as well. But the biggest risk of a recession is talking ourselves into one. There is a lot to be worried about right now, but the biggest trigger for a recession right now is us talking ourselves into one. There has been a drop in consumer confidence. That is quite understandable with all the talk of high inflation, perhaps even a world war, as well as interest rate hikes. The loss of confidence promotes consumers to spend less and go on the defensive. Businesses invest less, hire fewer people, retail sales drop, therefore manufacturing and output drops as well. This all leads to higher unemployment. Think about it yourself. As you see things become more and more expensive and you have less spending power, you decide to cut back on some of your costs. But you also notice that some products you will need and they might be more costly in a few months' time. Therefore, you rush out and try to buy them. This actually adds to the inflationary pressures. Businesses, banks and investors are less likely to invest and take risk. This impacts the wider economy and a recession kicks in. The chances of a recession over the next 12 months are reasonably high, perhaps 40 or 50%. Some countries will definitely experience a recession in the next 12 months. And this is quite easily understood considering how much growth there has been in the last 2 or 3 years. If you consider all the tech and pharma company growth that there has been globally, as well as the amount of money that has been printed globally, and all the public investment around the world. As that slows down, it's going to end up leading to a few slower months, and therefore a recession will kick in. But what does this all mean for the housing and property market? Before we can consider that, it's probably important to consider some of the positives. Historically low interest rates, record levels of savings on deposit, wealth and wages are at an all-time high. It's not easy for everyone, I get that totally, but the amount of cash out in the market at the moment is extremely high. Also, so far, many of the major international companies are still showing very positive signs and hiring as well. Let's assume a recession kicks in the next 12 months, consumer confidence drops, people and businesses stop spending money. This means that there'll be fewer home buyers and less demand, but it doesn't mean there will be an increase in supply, and price drops may be very dependent on location. Less people will be willing to sell at a lower price because it takes time for the market to adjust. Also, developers will be less likely to develop in a recession, which will reduce supply even further. In terms of commercial and investors, many will pull their funds from riskier assets and try put those funds into cash flowing assets such as high dividend shares or even rental property, as real estate is seen as a low risk over the long term in high demand areas. If inflation continues to be a concern, holding cash will not be wise. Investors will look to cash flowing properties to secure their wealth. If inflation continues, it will also impact construction costs, leading to less supply, as well as increasing refurbishment costs, again leading to less supply on the market. Due to the lack of construction in many areas over the last 10 years, low interest rates, huge amount of cash on deposit, as well as inflationary concerns, as many luxury properties and prime properties are being bought by cash at the moment, the price reductions may not be massive in a short recession. Properties will stay on the market longer and they will be slower to sell. Low income areas are likely to suffer worse in a recession, as the majority of buyers require a mortgage to buy the property, and banks may be less likely to lend in a recession. Trying to be level-headed about this, a short-term recession may not be the worst thing at all, and it might be good to take some of the heat out of the market, as well as help reduce some of the inflationary concerns. This would help reduce construction costs and hopefully increase supply once the recession was over. If you are worried about a recession and wondering how you can protect yourself, the most important thing is protect your income and have as many income streams as possible. Do not over leverage yourself. If you do have cash to invest, speak to an expert. This is not advice. The general rule of thumb is to try invest in high cash yielding investments such as rental properties or high dividend shares, as they tend not to be as volatile in recessions. If you believe we're heading into a crash rather than just a recession, it is possible, but the odds of it happening are far lower. There are risks out there. There's a risk of a world war at the moment. I hope to God that doesn't happen. There's also longer term risks in terms of a global shift in power dynamic, but hopefully there's no major crash on the cards anytime soon. If you want to know a little bit more about me personally, as well as some of my history in property, I did a recent podcast with Behind the Facade. I will leave a link for that below in the description. I hope you liked the video. Please help the channel out to grow to a wider audience. Give it a like, subscribe, and make sure you comment and even share it.